It's old school. It's got Scott Thompson and James Boyd here, and we welcome Scott. And it's always great to have him here in the chat. You know Scott because he teaches getting started with stocks, and so we welcome him. We also welcome all of you. David, hello to you. Kelly, Will, Grace, Jay Richardson, and many others. Viraj and Wiley, hello to you. Now, just real quick as we're getting started, there's Scott Thompson's handle for X at Scott Thompson CS. You'll see that right here. And nice little picture of Scott and his wife. That does not look like it's in Utah because it's not. And follow him because he actually posts educational content there. Also, you're going to see my page right here. Posting some interesting information this week. There's been a lot of data points that have been coming out that are noteworthy to take a look at. And also, just a quick reminder that as we're getting started, we broadcast our classes out on YouTube. That channel on YouTube is Trader Talk Schwab Coaching Webcast. That's important because that means you don't always have to be sitting at your computer to be watching our classes live or the recordings. My wife calls it a man purse, but I take around my pad with me almost everywhere I go. That way I'm always kind of seeing the markets and able to consume the content that I want. So check that out. That's a nice thing about broadcasting on YouTube. Now, just real quick as we're getting started, remember that the information here is provided for general informational purposes only, should not be considered individualized recommendation. When we talk about this class, we'll talk about stocks. If we bring up options, understand that options are not suitable for all investors. Also note that not everyone is the same. Some people want to maybe do stocks. Some people want to do, let's say, options. Some people want to do income. Some people want to do growth. Some people want to do value. Some people want to do tech stocks. Some people want to do utility stocks. We're all coming from a different angle. And so we kind of consume. You get to choose whatever you want, okay? But that's why we teach different things. And there's different classes based on different topics for that reason. Now, remember that also, when we talk about examples, we will do those in the paid money software application. Investing involves risks, including loss of principal, and for some products, loss more than your initial investment for some products. Now, also just real quick, if you went to schwab.com/events, you're going to see the outlay of the calendar for the different events we have for the year 2026. Today we're in Boston, and tomorrow Boston. And then coming up, we're going to be on the March 16th. We'll be doing the Chicago Market Drive, Renaissance Schaumburg Hotel. And you're going to see that's a one-day event called the Market Drive. We will be in San Diego June 5th and 6th. First day technical analysis, second day option strategies right at the Marriott Marquis San Diego Marina. And also the 17th and 18th back in Chicago, the Renaissance Schaumburg, the 17th and 18th of July. Now, you don't have to be living in those areas to go to those events. You might be visiting family, vacation, work trip, whatever. If you could just go to schwab.com/events, you can see all of the different places that we're visiting. We are going to, check me on this, I think it's actually November, early December, Honolulu. So, Scott, I'm saying that because you're aloha. Okay, speaking of aloha, I'll be there in 6 weeks. But the biggest actually thing is want to make sure you're available or aware that these are available and check those out. Now, just real quick, as we get started, let's go ahead and kind of talk about the topic, okay? So we know that in the current market, we have seen, by the way, this is my 7th class for this week. And what a sheer joy it's been, okay? We've learned a lot over these last 2 weeks, to say the least. And I cannot say it's been taxing whatsoever, okay? It's been a sheer delight, okay? Now, when we talk about the markets, our focus here today is if we were to ask people, such as the question like, what patterns in the market do you see most right now? Well, I think a lot of investors would say, James, I'm kind of seeing like a lot of continuation patterns. Now, since I'm on the weekly chart, I'll just go here first, okay? Now, if we look at just real quick the S&P, we've seen kind of this behavior sometimes before. We saw it last April, last March, where we had like a sell-off, And that sell-off was when they started talking about, hey, maybe charging others to sell their products in the United States of America. And we kind of saw this before, right? Now, I'm not saying that drop in the price is always, it doesn't feel great, but there is sometimes news that hits the market. It's just not great, okay? Market wasn't expecting it. Uh, if you kind of take a look at recently, you see this pullback in the price, kind of something similar. And what you'll kind of notice is here we are pushing to the upside. Both of these are your classic V patterns, okay? We could also see with that U patterns. We could also see with that what's also known as the C and H. And what is C and H? Cup and handle patterns. That actually kind of looks like a little bit like a sideways, maybe a tilted up W, if you will. And I don't care if you look at a V pattern, a U pattern, a cup and handle pattern. What it really comes down to is using that tool of Fibonacci. Very important, okay? Now, the Fibonacci's are, of course, built off the numbers of Fibonacci, which is 1, 2, 3, 5, 8, okay, 13, 21. It's just additive, okay? And then 34 and so on, and 55, okay? So if you look at this, now the percentages, if we actually said, well, where do they get the numbers, right? Well, it's 1 divided by 2, which is the lower number divided by the higher number, would give you 50%. Well, if you take 2 divided by 5, that'd be 40%, or 38, which is on the chart. If you take, let's say, 5 divided by 13, it's going to give you a percentage. So the percentages are really based upon taking the lower number divided by the higher number, or the higher number divided by the lower number of the Fibonacci numbers. That's where the percentages are coming from. So if we're talking about V, now, by the way, that's classic math. We could have a class on math, but the class is not on math. It's on technical analysis, okay? So that's a whole nother class. Now, these V's use cup and handles. Fibonacci is probably the most likely tool that a technician will be using in this type of market environment. So the information we talk about today is applicable for the current market. It's focusing on daily charts, yes, but it could be weekly charts, okay? It could be a different type of asset. It might not be a stock position. It might be something else like I taught this morning, like ETFs, okay? So what we're talking about is applicable to different things and different time frames. Now, if we look at the weekly chart, if we were to close here, just have to be the bearer of bad news. Brand new high, okay? Now, if you look at this on the NASDAQ, we'll just fast fire, and then we're going to go look at this first example. There's the NASDAQ, okay? Now, a little fun. There's always like maybe someone that might say, James, we're 10 points off the high. I'm calling the top. Not sure if we would say that, but yeah, someone sold a little bit, okay? And if we look at the Russell, okay, said, could the Russell kind of get into action? Pretty good gap here today. Not much of a lower shadow on the gap up in the price here today. I mean, that gap, and it just ran, okay? And the one that we made mention of yesterday is, could the last of the four, the Dow Jones, play a little catch up to the other three? Now, I mean, not a bad way to kind of go. Just give us 1,000 points, okay? Here's the Dow finally playing a little catch up. So kind of pretty interesting here seeing some of the moves. Now, some of the things I'm just going to verbally speak to, I won't pull up, okay? Keep an eye on gold, okay? We saw the dollar fall pretty aggressively here today. When we say gold, we'll say silver. When we say gold and silver, we're going to say copper, okay? When we say copper, which is at the horizontal resistance, 2 stocks to keep an eye on, FCX and SCCO, okay? Now, that's not part of the plan of what the examples are going to pull up, but that's notable to keep an eye on, not just these stocks, but we know things like commodities can also be an investment vehicle, okay? And so that's why there is different topics, because sometimes what people buy is not just stocks. Some people want to buy physical assets like commodities and so on. And trends are not just in stocks. Let's just be real. Now, what I want to do is I want to pull up example given. I'm going to pull up RL. Now, RL example given is your classic example of what we're seeing in the current market right now. Now, if you have questions as we go ahead and type in those questions, okay? I'm going to get to kind of things that are most applicable. And as a teacher, I want to make sure that you're prepared. I don't want to tell you a week after the fact, okay? That would just be horrible. Now, if these patterns happen, okay, I want to make sure you have an understanding of what they look like, how to read them, and how to trade them. Now, in the example, I have Ralph Lauren, RL. If you look at the chart, it kind of does really look like your classic U pattern. That U pattern, we see a pullback in the price, okay? Now that pullback creates the opportunity. One touch on the bottom, two touch on the bottom. Give me three. And there's four touches. Now this little run back to the upside, there it is. There is your classic cup. Some people call it a bull. Take both. Now, on the right-hand side, what do you notice? Well, many investors who'd like to trade bullishly. Now, Scott Thompson, he might know something. Now, here's the funny thing about Scott, okay? If you say the word flag to Scott, I mean, he might know something about that topic, okay? Now, on the right-hand side, what you're going to notice is we kind of have this slant down. That slant down was created by the red candles, lower highs. On the right-hand side, seeing a little pop to the upside. Now, what you're now going to notice is this resistance line, that matters because now you're seeing that this pattern now becomes a measuring technique. That if we look at this and we say 385, let's say we said that was resistance, and we say on the bottom 330, okay? Well, if we look at that, 330 to 385, manually, we could actually say, well, the depth of that cup is about $55. We take the 55 and we add it to, okay, the resistance, and it gives us somewhere in the vicinity, check my math on this, I got about 440. Now that's just if we just do it manually. So number one is, could the investor buy RL before the horizontal breakout? Yes. Now, again, if I'm guilty of anything, I'm guilty of talking about dollar cost averaging. I know some of you don't want to hear it. Here's the deal. It takes you probably 10 times to hear it to let it sink in one really good time. Now, in our example here today, we're going to take a Ralph Lauren position long, and then we're going to talk about a potential add point, okay? So now the first thing is, what we did is manual. But is there a way to kind of see these support and resistance levels from kind of something that's already drawn out for us? Yes. Welcome to the Fibonacci tool. Now, here's the deal. We're going to go back to this clear the drawings, we'll close that down, and what we're going to do is we're going to draw from the high, the prior high, we're going to draw down to the base of support. Now, why? Well, what we're going to do is we're going to go back to that little percentage right there. Click on that. We're going to go right back up to the very top. Now, here's the thing. If people are not familiar with this tool, it just makes me sad. Because I have said over and over again that investing is math and psychology, okay? And that psychology then turns into discipline, routine, and a trading system, okay? Or an investing system. And what we're now going to do here is let's kind of show the math. Now, part of this math, we can also kind of see some of the psychology of the recent trend. Now, what I'm going to do is I'm going to kind of grab this down a little bit to where we can see this. And now I'm going to kind of resize this graph. So what we can now see on this chart is, okay, lines. Now these lines, the 23, the 38, the 50, we know where those percentages are coming from. The Fibonacci's divided into each other, 1 divided by 2, 2 divided by 5, and so on. And now what you're going to see is the 161 and the 200% extension and the 261. Those percentages are found by taking the higher numbers divided by lower Fibonacci numbers. That's where they're coming from. Now, one of the things that we did add here is the 200%. On yesterday's session, we talked about the 200%. That's not Fibonacci. That is your channel. For some of you that actually track our normal classes, many of our examples are looking for channels. And the channels are potential ranges, right? But those ranges sometimes break. And if those ranges break, it might try to travel the width of the channel, up or down. And if we look at the distance between the X's, that's what the 200% is. Okay? So if we said, what's the distance? Well, from there to there, it's about $54. Add the $54, it pretty much puts us into this range right there. How do you actually put that on there? Okay, which would be a really good idea. Well, what we're going to do is just right-click on any of these lines. Right-click, edit properties. Okay, so not too bad. Right-click on any of the lines. And what we can do is just put in here a line. Yours will give you one more line. Take that one more line, or if yours says 4.328, whatever, take that out and just type in 2 for 200%. And make sure that it's checked. So that way we can go back to the chart, it's going to show that line. Now, if I actually go back and say click OK, that line should now be showing on your chart. Okay, now Viraj actually says, why you went from wick to body on Facebook. Or for Fib. Well, I really didn't go. I mean, I was kind of measuring from that body right there to the bodies of the candles. So, I mean, it might have been the wick there, might have been the wick there, but I was kind of taking that highest point right there, the body of the highest body day, okay, which was the date of February 20th, okay, and drawing down to the bodies of the candles. Please don't say that I draw from wicks. Okay, now, here, a little fun there. You know I'm not a wick person. Okay, I look at where we get more statistical data points. Now, here's the deal. On RL, trade number 1, we're going to right-click on the chart. So remember we kind of talked about what is it? How does it potentially work? What's the setup? And then how do we trade it? Now, in our example, now, there are some of us here that are stock traders. We might have more capital. Okay, and we don't mind to maybe use that capital. And the other thing is we don't maybe want an expiration. We don't want a bid-ask spread. We want maybe a dollar for dollar exposure, and we don't mind to invest a greater amount of capital. So someone might say, I don't do options. That's fine. You're one of many people in the stock market. Now, there's other people that said, I don't have that much money. Or is there a way to maybe try to trade the trend with the use of a derivative, and so on. So there's different types of investments and strategies for that reason. Now, what I'm going to do is I'm going to go buy custom. I'm going to go with OCO bracket. Now, what I'm going to do is if I do that buy custom with the OCO bracket, I'm going to take that target number 418.15 dated GTC. Okay, there it is. There's the target. Now, if we said, why would a bullish investor give a reason for using Fibonacci's? Well, one of the main reasons is for potential support resistance levels. If we're talking about a bullish trade, we might be thinking, yay, the resistance or the extension for the target, yes, but also the retracement for a potential level of support. Well, that nearest potential support was 373.04. 373.04, right there, less 2%, 365.57. Now, what I'm going to do is 365.57. 365.57 dated GTC. Now, let's say we said in this example that we were going to buy, example given, $5,000 worth of stock, hypothetically. Well, if we did that, it would really be about 12 shares. It's a bigger dollar stock. So now what we're going to try to do is see if this trend can't continue. Now, here's what's kind of interesting. Patterns can repeat themselves. Now, sometimes we don't realize, A, that there is a pattern, and then 2, we don't realize that those patterns sometimes can repeat themselves. Example given. So this is trade number 1. Now, here's the deal. If this stock runs to the upside, Let me just draw this. Let's say it runs to the upside. We get a green candle. Okay? Green candle. And all of a sudden, we actually see that the stock then pulls back a little bit. Now, if we get this red type of candle, are we thinking, man, this is a failed breakout? Is that what we're thinking? Are we thinking, my gosh, this is the top? Now, if we get a red candle like that, we're thinking that this could be the pullback for the what? Type it in the chat. If we get this type of setup, breaks out, goes to a brand new high, and if you make a higher high, the highest likelihood is a what? Type it in the chat. A higher low. How do you get a higher low? You gotta get a red candle. And the red candle is above the what? The support. Okay? You do not get higher lows without red candles. So step number 1, make a high. Step 2, red candle or candles. Step 3, those red candles are above the moving average, old resistance, potential new support. You're in the process of making the higher low. You got to understand something. Red candles are your friends. They're giving the investor the opportunity to try to get in on the bounce setup. Now let's take it the next day. Let's all of a sudden say the candle looks like this. Well, what do you call that? Well, that's your down day, red candle, close higher day. And what are you thinking at that point? Well, that's not your hold. That's your down day, red candle, close higher day. We call that a trigger. And if we see that stock gap to the upside, that means that those investors were lined up, ready to buy in the morning that caused the price to gap to the upside. So if we draw this, if we see that price gap, okay, like that, and we saw, how many of those did we see this week? Okay. If we gap to the upside, that means other investors saw the setup, they buy, even in the pre-market, and they're thinking they're buying off that support level. Now, I wonder if it doesn't do it like that. Wonder if it doesn't gap. But all of a sudden, it actually does something like this. Well, there's your close above the high of the low day. Okay? So, we're going to take the first Ralph Lauren position long. But over the next couple of days, I want to see, can we get a new high? Second, can we get a red candle? That's the setup if it stays above the old resistance, the moving average. And can we start to get one of the two variations of a bullish bounce? Close higher gap, which is a 3-candle pattern, and a close above the high of the low day, which tends to be a 2-candle pattern. Now, here's the thing. The fun thing about the hold or the close higher gap, it's not product specific, meaning it's not stock only. It's in different products as well. It's different time frames. It's using the same bounce methodology practice, which, by the way, those acronyms, I created those. People would say bounce. I kind of created close above the high of the low day. Who created the CHE? I did, because I kept seeing these same patterns over and over and over. When did I create them? Probably about 2005. Okay, right around there. So 20 years ago. Now, the big actually thing is if I go confirm and send, we can send that. Remember how the stop works. If it goes to that price or less, sell. Now, the biggest sell at that price or less. Now, the one thing I want to just say real quickly before we go to our next example. Remember I kind of said, let me take this off just real quick. When we go, oh, I don't want to do that. Let's go delete that. There it is. If we were to go back and look at this just real quick, and I don't like to give history lessons, but this is a good example. What you're now going to notice on the chart is there's been previous times that it's done this. Okay, prior high, pullback, base, little breakout. Old resistance becoming new potential support. Rally to the upside. Does every time the market pull back or Ralph Lauren pull back, does it always break out to the upside? No, it didn't right there. It took it the second time. Now, that second time, it rallied right back up. Old resistance became new support. Ripped to the upside. Kind of looks like the same pattern that we're seeing right now. Similar. Pullback. Old resistance. New potential support. Rip to the upside. Pullback. There's your handle. Notice when it breaks out to a brand new high. Makes a new high. Pulls back. Old resistance. Potential new support. Rip to the upside. So here's the deal. Sometimes these patterns can play out and we want to make sure that every time we see the pullback and we see the pattern, can we be comfortable in seeing how to potentially play it? As every time we see a continuation pattern, is it always going to look like that or perfectly like we would see in maybe a book? Probably not, okay? So speaking of that, let's show some other examples. Now, let's time out, okay? Question from Art, okay? Art says, what if you have to start all over again? What is the most important technical indicator you could use? Now, let me kind of show you something, okay? Now, what I have on here is the MACD histogram, okay? I'm going to also pull up the stochastics. And let's say I use even like example given, like a full stochastics, okay? Now, let's say I use also RSI, okay? And I put it right there. And I'm going to put CCI, okay? Now, so the question from Art, let me repeat that just in case we're all on the same page. Art is asking, what is the most important technical indicator? Okay? Now, I want to be very crystal clear on this. So number one is I'm only going to use the oscillators at the bottom. MACD, stochastics, RSI, CCI. Okay? Now, a lot of people don't say this. Well, I'm going to say this. Okay, now, right around, if we kind of looked at when the MACD went green most recently, you're going to kind of see that the stochastics was in that oversold, right? Would you agree with that? And it started going up. You're going to notice that the RSI was kind of in the middle of the range, but it also started going up. And if you look at the CCI, like the stochastics, it was in the oversold and started going up. Now, here's kind of like the headlights are just staring right at you now, okay? And if we looked at all the oscillators, we would say, geez, if I use the MACD, stochastics, RSI, CCI, they all were pointing to the upside. No kidding, okay? If you say, what do you try to teach the most important indicator is the price. The oscillators don't move by themselves, okay? The oscillators are moving based upon what the price is doing. The reason why the price graph is bigger than any of the oscillators is because it's the most important. Now, if we went back to this just real quick and took that off, okay? Now, if we looked at the price and said, okay, how on the price is it how do I learn to read the price? Well, we have different moving averages, simple moving averages, exponential moving averages, weighted moving averages, whole moving averages. Some are you kind of using more slower type of formula to actually create the moving averages. As some I mentioned, exponential. Think of simple as arithmetic. Think of exponential moving average like geometric. Okay, it counts the more recent days heavier. Think of weighted as more to the recent, kind of like exponential. And whole is like the fastest way to kind of see what the trend and or momentum line are really doing. Now, what's kind of interesting is if you look on this price graph, on the right-hand side, the oscillators, how are the oscillators helpful? Those oscillators can also show us maybe a little heads up, like a bullish MACD divergence. Like when you notice that we were kind of down, the MACD was down. The stochastics was in the oversold. This RSI was kind of more in the neutral range. The CCI was kind of in that oversold. So what does that kind of tell us that price might not be telling us? Well, it might be telling us if we're in that oversold, be on the lookout for a potential reversal on the what? Price. Now, what would actually tell us that price is changing? The 10-period moving average line going from red to green. 20-period moving average line going from red to green. What's more confirmation? Moving average crossing over. Ladies and gentlemen, boys and girls, we got to understand something. That price graph, that is the most important thing. The oscillators could be showing oversold, overbought conditions, but the real indicator is price. Okay. Now, with that price, as I talked about on Wednesday and I talked about on Thursday, the confirmation of that maybe other investors are seeing what you are seeing is volume. If you start seeing volume tracks on the stock volume tracks on the option volume on the option strike compared to the open interest, which we're still seeing. If we start to see that happening, stock volume, option volume, it's just more and more confirmation that other investors are trying to put trades on to ride that trend. And we know that not everyone attacks the trend with the same tool. Does that make sense? All right. Now, comment from Wiley is all crystal balls have been recalled. As soon as you realize that no indicator can tell you what happens tomorrow, the better off you'll be. Okay? So you can look at the price, say bullish, it was bullish today. That doesn't tell you what it's going to do tomorrow. No oscillator is going to tell you what it's going to do tomorrow. That's why people wake up and evaluate what the market is doing. As soon as you realize that, the better. Okay? You can't know tomorrow. That's why you're managing risk. That's why you're investing a certain amount of capital, because you don't know what tomorrow is going to what tomorrow is going to bring. Okay? All right. Now, the comment from One Morning Rush at James, what would you recommend for price monitoring that is best for trend trading? Exponential, whole, crossover of EMA, etc. Well, this is why we kind of have different charts, okay? If you said to me, James, I'm a little bit more of a trend trader. So this is what else I would say to this, okay? It's not necessarily what the oscillator is, it's the setting, okay? So if you said to me, hey, James, I'm actually more of a trend trader, okay? Well, we could use things like a whole moving average, but just slow them down to not a 10-20 setting, but maybe a 10-30. That would be maybe the number one setting we could look at. If we said, well, I kind of like to look at things from a weekly to a monthly perspective, using a standard 10-day exponential, 30-day simple might be a secondary setting for that type of investor. Okay? So it's not just what the oscillator is, it's what setting you're using. Now, there could be 50 different settings, but there's normally 1, 2, or 3 that are probably most frequently used, but that's why there's default settings. Okay, now, so I would say those are probably 2 of them that we would look at. Now, let me kind of show you a couple other stocks. Let's say the investor said, James, I'm a trend trader, and I'm actually looking for setups. Well, one of the type of setups we're actually looking for is stocks that are breaching resistance lines. So our focus here today was talking about Fibonacci's, cup and handles, U patterns, V patterns, and so on. Well, we might ask the dominant question, which is, how do you find some of those? Well, one of the most common ways to find those of 3 is the tools here. Number 1 is a 20-day high, okay, which is just looking for the stock to make a 20-day high. 20-day high is about a 1-month high in the market. Think of that as short term. Second would be a 55-day high. Think of that as more intermediate. It's about 2.5 months. But the one I really want to focus on is this script right here, the breakout script. Now, if we right click on that and go customize, or excuse me, edit formula, and I'll share it. If I go edit formula, the one thing we want to kind of make sure that we understand is it's really looking for, it says this script is meant to be stocks breaking above a resistance point. Green would be bullish, red would be bearish in the last 3 days. Well, what's the duration of time it's using to see a breakout of the last 3 days? Well, if I kept reading, it's actually telling us that if we're looking for a resistance level, it's the last 15 days. Well, how long is 15 days? About 3 weeks. So it's slightly less than my 20-day right there. Now, if we were saying I'm looking for something that's breaking support, well, it would still be the last 15 days, 3 weeks. Now, in our example here, the only thing that's actually hitting that fresh new low over the last 15 days, we got a breakdown. Now, the significance of this breakout column is it's telling us, is the breakout today? Or is it like is it a continuation from yesterday? Let me slide this over. Let me widen this out so we can see this. So if we're getting like a breakout today, now remember, when we talk about scripts, they're not guaranteed for accuracy or timing. As an investor or trader, you should understand and number one, what is it trying to do? Verifying that it's showing correctly and having an understanding of it. That's helpful with any tool. So if we looked at this and said, hey, what's showing a breakout today? Now, are all of these examples of cup and handles? No, probably not, but they're examples of stocks breaking horizontal resistance, which could be cups, V's, U's, and so on. Now, if we took a look at this, okay, that American Express, today breakout, today. Now, if we said Microsoft, this is a continuing breakout from 2 days ago. Today breakout, today breakout, today breakout, today breakout, today breakout, today breakout, today. Oh, just rub it in. Well, I'm not trying to do that, okay? I'm just reading what it says on the chart. You realize that's what the job of the technician is, right? Read the chart, okay? Not fight it, read the chart. Now, the other one that's kind of getting a little pokey poke is Apple, continuing from 2 days ago and so on. So if it's green, it's actually bullish, okay? Bullish breakout. Red, bearish breakdown. Now, if we take a look at this, edit the formula, let me share that with you, and you could put that on your chart right there. Now, here's the thing. Sometimes as an educator, sometimes, man, people get mad when I talk about bullish breakouts. I don't know. Sometimes we can expose what we have without saying it, okay? Now, I'm not saying someone's doing that, but it seems like that, okay? I don't know for sure. Now, here's the deal. I don't know anything. The biggest actually thing is when you take a look at this, you can add that to your script. Now, let's kind of pull up in the last 8 or so minutes. Let's say you said, James, I'm really kind of one that looks at maybe daily or weekly charts, okay? Or I'm an investor that likes to look for weeks to months. Well, with some of the news we got here today that, and by the way, I got to show you this. This is kind of funny, okay? To show you, if you're not on X, you're kind of missing some of the humor, okay? Here we have actually the picture of the Strait of Hormuz. And someone actually drew candlesticks and said, if you want to kind of identify what's happening in the last 6-7 weeks in the market, the candlestick pattern looks very much like the Strait of Hormuz. Now, I'm not sure what happens on that right-hand side, but I thought that was a little humorous, okay? It's Friday. We can all laugh a little bit, okay? Now, here we go. Now, if we went back to the chart, let's say the straight stays open. Let's say, hey, the market goes up higher. Now, remember, GM is discretionary. You kind of need a car, but maybe you want one. Maybe you want one that you're willing to pay a little more for. Now, what I'm going to do in this example is, if we went back to this, now remember, we're talking about Fibonacci's, okay? Every time we use Fibonacci's, does it have to be something hitting a brand new high? No. Well, how do you draw them? We're going to go from the old high. Now, when I say high, I'm saying the body of the candle. Then we're drawing down to the low, the body, where there's more statistical touches, okay? Now, I'm going to draw from right there, okay? That's where the prior high was. I'm talking about the body. Then we're drawing down to the body of the candles, right here. Now, I want you to kind of notice something here. Oh, James, you took the easy one. I swear I did not pull this up ahead of time. Well, it's kind of interesting to kind of note right here in the last couple of days. So when the price got above recently, both moving averages, the color of the candle went that darker green. What does that signify? Price is above the shorter term moving average, the 10, the blue line, and the 30-day simple moving average. So we're showing some momentum and price above the 30 simple moving average. We're using that as a proxy for trend. Now notice that at that same time, the stock sits its body of the candle right on the 23% fib. What's the resistance? Next resistance, the 38. What happens? Price actually gets above the 38 and then rams its way to the 50. Okay? So it smashes through two potential resistance levels. Gets to the 50, potential support 38. Now, does it hold it perfectly? No. In this example, we see it go down slightly below the 38, but bounces off that upward trending moving average line. Boy, we've seen this, haven't we? Okay? Now, if we look to the upside, what's the resistance? The resistance is the 50, the 79.41. The next resistance could be the 61. Okay? Now, here's the deal. The funniest thing, well, it's not funny. It's actually kind of irritating. It's okay. Sometimes what will happen is people will say, look, I'm not going to get in here. I'm not going to get in here. I'm not going to get in here. I'm not going to get in here because we don't know. Now, remember what we said before. You never know what's going to happen tomorrow. And if someone tells you that they know what's going to happen tomorrow, they don't know, okay? They might have odds of what might happen, but it ain't never 100%, okay? Now, here's the deal. The investor, if they wait until it goes above 100, now, and I just heard this the other day from a friend of mine. I just said, you realize what you just said. My friend said, hey, now that we're at the high, the RSI is in the overbought condition. And now I'm going to need to wait for a pullback. So he said, I need to wait for a pullback. When he finally got the reversal of the crossovers happening, he said, we don't know what's going to happen tomorrow. So he didn't buy. And then the stock actually went to a brand new high. So can't buy now because now we're at all-time high and the oscillator is showing overbought. You ever heard someone do this? It's kind of a little comical, okay? So the moral of the story is that some investors realize is they're trying to buy on the pullback, and the investor does not have to wait until it hits all-time highs. They're trying to buy off the retracement levels, okay? They're trying to buy off those retracement levels that might act like potential levels of support. They could be buying levels, potentially. They could also be areas in which they're setting their stops underneath. They could also be targets, okay? So applicable on both sides, supports and resistance. And also it's kind of a way to kind of gauge momentum, trend line, if you will, and just kind of overall sentiment, okay? All right. Now, I got to say this kind of in wrapping up here. Couple stocks that I want us to watch, okay? Now, example given what I'm going to do in this time, for this time's sake, let me just kind of put this trade on. I'm going to right click on the current price. I'm going to go down to buy custom with the OCO bracket. As you look at the stocks this weekend, I want you to practice drawing Fibonacci's. James, okay, fine. I'll do one or two of them. Look, that's what my kids say. Dad, I'll do one or two. No, you don't do one or two. You do 10, okay? You got to do at least 10. And the biggest thing is you need to see practice because each stock that you look at will be drawn slightly differently. Some will be like GM. Others will be like the first example we showed, like Ralph Lauren. How many? 10 or more. If you do one or two, talk to Scott, okay? Now, what I'm now going to do is I'm going to take not that first support level, the second one. Notice that second support level is at 77.85. 77.85 less 2%. That's going to be 76, okay? Now, sometimes people will say comments like, well, if I get in, I don't know where to maybe consider exiting. That's kind of the purpose of today's class, okay? So we got to target, right, the prior high. Notice that actually we're setting a stop underneath, not that first support level, the second, trying to give a little bit more room, okay? So first trade example we did was RL. Second example we did is GM. Gave you a homework assignment. How many do we need? 10. 2 handfuls, okay? Need you to practice stocks that are hitting new highs, other stocks that are not, but are curling back to the upside, okay? Now, I also want to kind of make sure that we understand that our next session we have will be Brent Moore's, which will be doing a class on advanced options. Join us. I'll be in the chat. I also want to kind of make mention, if you have not subscribed to the Trader Talks channel on YouTube, do so. Just subscribe. It's free, okay? That way you can also see all of our classes on your mobile device, and also watch them recorded or the ones that have been archived. Also remember that you can go to schwab.com, go to learn, and then Schwab coaching. That we could also see our other content, such as where's the calendar for what you teach, or where are the in-person events, and so on, or who are the coaches. And you get to pick from the coaches that you like to learn from. And so make sure you're aware of that as well, and I'll post that right there. Now remember that with what we discuss here today, Fibonacci's, U's, V patterns, continuation patterns, we really talked about breakouts, and this is kind of a lot what we're seeing in the market right now. Go out and practice. You'll have some time to do so over the weekend and be prepared for next week as well. Remember, with what we discussed here today, sample illustrated purposes only. Cameron May will be back next week. This has been the session on advanced charting techniques. Thanks so much, Scott, and thanks to all of you. And take care. Bye-bye. And stay tuned for our next webcast coming up next. Bye-bye.